Okay, so we are going to do, I guess, an in-depth discussion of one of the causes of the AFC. Specifically, what we are going to discuss today is the foundational factor for the AFC. Now, your schools may call it differently, or rather, give it different names. Things like financial liberalization problems or premature financial liberalization. But really, what's at the core of it when we look at the concept of how governments affect the economy through its laws and policies. We are looking specifically at the monetary policies of the nations who are most badly affected by the AFC, and that will be Thailand, Indonesia, and Malaysia. Now, unfortunately, to fully understand this particular factor, you're gonna need some basic economic knowledge or finance knowledge, and as we go along, we would define what they mean. So first off, what's monetary policy? In short, monetary policy is the policy which a nation undertakes to control its money supply. Now you might be wondering, okay, then what's money supply? In short, money supply just refers to how much of your nation's currency is out there in the economy. The idea is that the higher the money supply, the more inflation there is. Because if there is a higher money supply, that just means that there is literally more money to go around, which exerts an inflationary pressure on the prices of goods and services. So how does a country control its money supply? They do it primarily through adjustments of its interest rates. And the interest rates are usually controlled by the central bank of a nation. So the idea is that when nations increase interest rates, that is meant to reduce or at least limit the increase of the money supply, that's out there in the economy. The idea is very simple. If you increase interest rates, that generally makes loans more expensive. So the thing is that in most cases, and again, this applies on a case-by-case basis, but in most cases, small and medium enterprises rely on credit. That means that in order to ensure the continuance of their businesses, they rely on taking on bank loans to finance their business operations. But if they take on bank loans to finance their business operations, if it's done excessively, this leads to very high inflationary pressures. So when you increase interest rates, the interest on the loans themselves would increase. So the thing is that whenever you take on bank loans, the bank would slap an interest rate on it. For example, if let's say you are taking a loan of $100,000, right, to finance whatever it is that you want to finance, the banks might offer hypothetically 5%. That means that on top of the principal sum of $100,000, you need to pay back, or rather you need to pay the bank a 5% interest rate usually in the monthly installment. And again, this depends on the contract and how long the contract runs on all these loans. So imagine if interest rates are increased. Wouldn't that make your loans more expensive because your interest rates are increased now? That means you not only have to pay back the principal sum, but you also need to pay an increased interest on top of whatever you need to pay every month. Now, at the same time, another impact that interest rates have on an economy is that it determines how much hot money inflows there can be. So hot money, essentially, short-term capital, right, is something that should be familiar to all the students taking econs. But for students that are not taking econs, right, just think of it as money that's coming into the economy in the short term, and these monies can be easily liquidated and leave the nation at the same time. In the context of the AFC, we are looking primarily at things like portfolio equities. That means investors from overseas opening a bank account in the respective nations in order to invest in their stock exchange. So knowing the impact of the interest rates on the nation's economy, right, now we need to apply it to 1997, or at least the years before that. The thing is that for Thailand and Indonesia, okay, both these nations had very high domestic interest rates. So when there are high domestic interest rates, that disincentivizes local borrowing. So a lot of the firms instead opted to borrow from overseas sources. So they wouldn't borrow from banks in their nations, but instead they would go to, for instance, Morgan Stanley in USA. But what that also meant was that foreign debts would increase. At the same time, since the interest rates were so high, that also led to an influx of short-term capital. So you learn from the factor of the speculative attacks that, at the onset of the crisis and when the nations floated their currencies, there was a massive capital flight, right? Yes, that was the impact from high domestic interest rates. So high domestic interest rates, in short, led to increased foreign borrowing and increases in short-term capital inflows. However, this doesn't really apply to Malaysia as much because Malaysia did not have as extensive a foreign debt amount as the other two nations. Instead, what Malaysia had really was high levels of domestic debts. And that is related to another factor which we won't cover here. Now, of course, it isn't just interest rates alone, okay? Because monetary policy is usually implemented in a, holistic way. But this next piece of analysis applies only to Thailand. So for Thailand, what they did at the same time was they created this institution called the Bangkok International Banking Facilities. What this institution did was that it gave out 42 licenses to different financial institutions and firms in Thailand. And this allowed them to act as middlemen between foreign sources of credit and local borrowers. So even if Thailand had implemented high domestic interest rates, that obviously didn't do much because of the presence of BIBF licensed firms and institutions. So these institutions simply, borrow from overseas sources and then they loan it to local borrowers, which, as much of these loans went into the real estate sector, which created a bubble. But again, we are not analyzing that factor here. And what this did was it increased foreign borrowing even more. Now, finally, the last piece of the puzzle, vis-a-vis the nation's monetary policies would be their pegging of their currencies to the US dollar. So how does pegging of a currency work? Essentially, nations would decide on their own what sort of value they would want their currency to be in relation to one US dollar. So they would maintain that ratio all the way. How do they then maintain this ratio? They do it through foreign reserves. So you might be wondering, what are foreign reserves then? Foreign reserves are essentially offshore piggy banks, I would say. Of course, again, how they do it is up to each individual nation, but essentially think of it as a piggy bank filled with other nations' currencies. And usually these foreign currencies would be key currencies. That means currencies that are very commonly used in global trade. And some of these currencies include, USD, the sterling pound, Japanese yen, the euro, so on and so forth. How these nations then intervene, right, is they make use of their foreign reserves to determine the money supply of their own currencies in the forex market or foreign exchange market. So if, let's say, the value of the Thai baht appreciates, that means it increases in value. That usually means that the supply of Thai baht is dropping because, basic economic laws, the laws of demand and supply. The lower the quantity supplied, the higher the price. So they will intervene in order to increase the supply of the Thai baht to ensure the maintenance of the value of the Thai baht vis-a-vis the US dollar. So for all three countries, Thailand, Indonesia, and Malaysia, how did this pegging of their currency to US dollar hurt them? For the case of Thailand, and I guess Indonesia as well, by pegging their currencies to US dollar, that created an implicit guarantee for local businesses that the governments would not change the value of the exchange rate. This implicit guarantee is very important because when businesses think that way, right? Or at least the optics of the exchange rate policy suggests as such. What these businesses would then do would be they would continue to borrow from foreign sources because they think that they could pay back the principal sum with interest at the same exchange rate values. So, end up what happened was it increased foreign borrowing while at the same time, alright, incentivizing these firms to take on much of these foreign debts in the form of short-term loans. That means they have a maturity of a year or less, or even more layperson explanation. That means they need to pay back the full principal sum with interest in a year or less. While at the same time, much of these foreign debts or foreign loans also would be unprotected against currency fluctuations. So because of this, what happened was a lot of the local firms in Thailand and Indonesia then started to borrow more and more and more and more and more from foreign sources. Because there was this false belief, like I said, that the exchange rate values won't change. Now, of course, they were wrong because at the onset of the speculative attacks, both Thailand and Indonesia very quickly allowed their currencies to float. They didn't float, it sank. Alright, and that in turn led to the massive inflation of all these foreign debts, which triggered a whole slew of defaults. That means, companies declaring bankruptcy and saying that they are unable to service these debts. To put things in perspective, right? For the case of Thailand, for instance, between July 2nd, 97 and December 97, the Thai baht depreciated by about 45 to 50%. If let's say we take the 50% number, what that meant was that you need to pay twice as much Thai baht in December 97 to service the same amount of loans that you took on from foreign sources, which also means that your loans became twice as expensive. And that's why all these firms started defaulting. For the case of Malaysia, on the other hand, the exchange rate pegging had a different impact, which was that when Malaysia pegged their exchange rate to the US dollar in turn appreciated during the early 90s. Alright, and you should know this because you learn about this in global economy for the H2 history students. So when the USD appreciated in its value, the Malaysian ringgit also appreciated. And since the Malaysian ringgit appreciated in its value, that also meant that its exports became much less competitive. Specifically in terms of price competitiveness, because now, other countries purchasing Malaysian manufacturers, they have to spend more foreign currency to exchange for the ringgit in order to buy their products. So current account deficit increased, or to put it very simply, the amount that Malaysia earns from its exports versus the amount that it spends on imports increased drastically. And what sort of impact did that have on Malaysia then? Since foreign investors were looking at Malaysia, right, especially those that either sent their hot money in or were, speculating on the value of the ringgit, they saw that, hey, Malaysia has such a high current account deficit. It was bleeding money because it was experiencing a net loss on its exports versus imports. For econ students, that just means that your X minus M became a negative value. So when investors saw that, then that raised certain red flags for them because they realized that, hey, if this was happening, what that tells me is that the government was reluctant to regulate and rein in the exchange rate values and rein in the declining weakness of the exports. And that then led to the speculation. So TLDL, in short, what the monetary policies of these three countries created were these. Number one, increase in reliance on foreign borrowing, which led to the increase in foreign debts. Number two, the increased vulnerability as a result of these debts being taken on with short-term maturities and unprotected against currency values. Number three, yet more increases in its vulnerability because of the surge in hot money inflows or short-term capital inflows. And finally, weakening exports, which raised red flags for foreign investors in these nations' respective economies. Now, of course, when all is said and done, at the end of the day, I would still like to urge students not to do AFC if possible, because the causes of the AFC are highly technical factors, which requires, quite a bit of an economic knowledge or financial knowledge to really go and internalize and understand, and then subsequently translate them into, layperson terms that you can use in your H2 history analysis. But suffice to say, what this factor did, in short, was to create fundamental weaknesses in the economy. But this explanation can only be used in your link after you have explained all the specific impacts of all the other things that I mentioned beforehand. So I hope this was useful. And if you found this useful, I would like to urge you to invite your friends, join the Telegram channel, and, ask questions if you can, obviously. That's the best way to learn. And if you need more in-depth discussions and so on, I'll be happy to schedule a consult with you, or, come down for a free trial lesson. These are the sort of in-depth explanations that you can expect for, I guess, not just H2 history, but for GP as well. So, yeah, have a good one.